Good morning, good afternoon, good evening, whenever you're watching this. Thank you for joining us. It is the Monday Market Update. I am Nash Paradise, Director of Sales, here with a very special guest for the first time ever joining the Monday Market Update. I have my buddy, business partner, and always punctual Tyler Hodgson. How are you doing, sir?
Yeah, I'm doing good. Very punctual, I believe is the term that you used. Excited to be here, long-time viewer, first-time co-host. So hopefully I can live up to the fame and hype of Mr. Matt Gouget.
I mean, you can't out Gucci the Gucci, so you just be the best Tyler you can, and we'll do a lot from here. So obviously we have a lot to cover. Last week was a train wreck. It was a mess. It was wild. I think anyone watching this right now has experienced something. It's not often that our world bleeds into the culture. And right now it is very much so. All you're seeing is headlines about tariff this and this thing on Twitter and pauses and restructures and tariff buckets and what happens with this. So we're going to go through our normal shtick and have a good understanding of what's going on the schedule this week, understand the economic calendar, etc. But we're going to do our biggest dive, our deep dive into how everything outside of our normal metrics is impacting us. So let's jump right into the slides. Take a look first at last week's economic news. So this should have been really impactful, right? There's a bunch of good stuff on here. Anytime we have CPI and PPI in the same week, that's going to be big. I want to bring your attention to Thursday here, where we're going through the headline CPI as well as the core. And, both the month over month and the year over year missed pretty severely, in my opinion. I mean, to miss by 20 basis points on the month over month for the, prevailing inflation figure, that one in the middle of the year over year core CPI, to go from a 3% forecast to 2.8, that's coming down a lot faster than expected. Tyler, what were your thoughts when that came through last week with inflation coming down faster than everyone thought?
Yeah, I mean, obviously, I thought that we were going to see a nice bounce back on rates. We saw really bad trends through the entire week last week due to the tariffs and things like that, which we'll talk about in a little bit. But when I saw the headline, I'm like, oh, great. Like, this can be the bounce back. This can be the rally that we needed. Inflation's coming down. Yippee, hooray. But it seemed very much ignored by the markets.
Yeah, 100% ignored. It just shows that, what's most important. So, we're going to highlight the things that look like they're very important. Ultimately, it's the money that moves, the $1 billion hedge funds, the international currency. I mean, we're talking treasury bonds, and there's a lot of different people with their hands in that pie. And, the typical market movers may not be so typical, which brings us to what we expect this week on market movement here. So I'm going to call this a quiet week. There's not, all the big stuff, the jobs report, employment numbers, CPI, PPI. We've had those for the last 2 weeks. So what we've got right now, New York Fed this morning met to talk about consumer inflation expectations. Okay, cool. That actually came in. I've already got the figures for that. That forecast is in at 3.6, which is interesting. So, prior was 3.1, now it's 3.6. This is a consumer expectation index, which tells us a lot about, what do we expect to happen. And if you'd done this poll a week and a half ago, I think we would have been closer to 2.8, 2.9. Instead, came in at 3.6. Tyler, why do you think we were so much higher on, consumer expectations for short-term inflation?
Well, it's everywhere on the news, and everyone's saying that with tariffs, everything is going to cost more. It's going to increase the cost of our goods. Those tariffs are going to be passed on to consumers. That's what the news and the media is telling us. And so that's what the expectations of the general public are going to be.
Yeah, I mean, you know what you know, and you know that things get more expensive when things get more expensive. It's fairly basic math on that. And yeah, if we're talking about starting a tariff trade war with China, that's going to increase the costs of half the things that we use. So it's expected to see consumer sentiment increase on that figure. Looking at the rest of the week, we've got some interesting retail sales percentages coming up on Wednesday. Okay. Jobless claims on Thursday should be a neat mark there, but we've been in line for a while on jobless, as well as continued claims, new claims, housing starts, building permits. They're not going to move the market. And then of course we've got, the market closed for Good Friday. So this week, nothing real interesting. I've got nothing to circle on your calendar here. It's not going to matter. For right now, it's the news cycle that matters. So let's talk about what this is doing to our updated Fed funds rate chart. This is fun, Tyler, just to kind of go over a little bit of what to expect here. What does this chart look like? This is showing us probabilities. Where should we be? And the interesting thing on this is really checking out the week over week over week. So the way to read this and where we are right now is, for the next Fed meeting on 5/7, we got an 85% chance of staying where we are. Right now, we're in that 425 to 450 bracket. So, okay, we will likely not see a rate drop, at that 5/7 meeting. Now we are seeing about 15% of people surveyed saying that we may. That's interesting because last week we weren't seeing that. So I think it's an all but certainty at this point that we're going to see our first rate drop in June, which is what's supported here. 81% are thinking we're going to have that drop by then, a second rate drop by September, and a third rate drop by October, with a fourth rate drop not really happening until March. So interesting. If you were here with us last week, you saw this. We were actually looking more towards an interest rate drop, a fourth drop by the end of the year. Now, not so much. So I'm going to kind of put you on the spot here with something you shouldn't be expected to know, but I'm going to get your thoughts. Why do you think we went from a near certainty of 4 drops this year to 3?
Again, I believe it was due to the impact of the tariffs and the thought that that's going to drive inflation up. So with higher inflation, the Fed's going to be less likely to want to cut rates.
Bingo. I knew you'd know. You're such a smart guy. I mean, I don't miss Gucci, but you're doing all right. Tyler's right. It is all about where tariffs are going. Tariffs are impacting everything right now. In the Fed, we've seen a number of speeches come out since the tariff discussion started. It seems like forever ago. It's like 6 business days that we've been dealing with this. But since then, the Fed has been pretty clear that they expect tariffs to drive inflation higher. We saw, New York Fed coming out with their consumer expectations saying inflation is going to go higher. Well, if inflation is going higher, we're going to get fewer rate drops. What does that mean to mortgage interest rates? A lot of nothing, really. If inflation stays up, it stays up. That's not going to have a direct correlation or causation to where interest rates are going. Whether we get 2 drops, 3 drops, 4 drops, these things may move in parallel to where we expect mortgage rates to go, but they're not necessarily directly impacting each other. So for right now, I haven't seen a lot of updates on where we expect interest rates to fall at the end of the year. In fact, anyone that tells me, hey, I know where fourth quarter is going to be, we're going to see, the 30-year fixed under 6%. Okay. That's great wishful thinking, and I'd love to see that too. But right now, there's nothing in the numbers that support that. I think we need to address, the elephant in the room, which is where interest rates are right now and how they got there. So let's jump to the next slide. This is something interesting I picked up last week, and it's concerning. This has been a talking point I've been having with my agent partners, with other loan originators. This is changes weekly in the 10-year Treasury yield. And Tyler, as you know, the 10-year Treasury yield is the closest indicator of where we expect mortgage-backed security pricing to come from. So as that yield goes up, interest rates tend to go up. Down, same thing. The change in the yield last week was the most severe that we have seen since 1981. Now, Tyler, I know you have been in this industry for a while. I think 6, 7 years, something like that, maybe 8 or 9 at this point. I don't know. You're getting old. How does this rank up here on, weekly disturbances that you've seen in the mortgage market since you started your career?
Yeah, I mean, I got in the industry in 2016. Well, I started working for a mortgage company in 2015, so almost at 10 years. And I was looking at some of these spikes here, and one of the big one, actually the second largest one you see there is right at the end of 2017. I think that was Brexit, if anyone remembers that.
Yeah.
Or that was the election, actually. It's like you had Brexit, and then you had the 2016 election, and that caused a big jump and a big spike. Obviously, you see a little COVID spike there, but yeah, I mean it's a historical week with how much rates moved up, which is really impactful, obviously, for the home buyers who are out there pre-approved shopping right now. For those who just went under contract, literally even over the weekend or during the week last week, if they were negotiating a home, I see a lot of times someone looks at a home on the weekend and they don't get a contract executed till later in the day on Monday or Tuesday. And it takes a couple of days to get these things, in the works. And those people are seeing a huge impact in what they may have expected on their interest rate compared to even if they had just gotten pre-approved the week prior. So it was a huge jump. 1981. I mean, most of us on this video call weren't even alive then.
There's two of us on this call. So that's a factual statement. Yeah. I was not born until 84. But I mean, you're spot on. And I think the other thing I noticed about this chart when I was looking through it was the number of large increases or large decreases just since 2020. I think if we pulled this chart way back for the last 10, 15, 20 years, you'd see a lot more consistency. Back in my day, started in 2006. We went through a lot. We went through the 2008, 2009 meltdown, the Great Recession. We saw a lot of things happen. That's all prior to COVID, which, most of us went through, lived through, and were working through. That got better in a hurry. And you can see where that COVID hit. And we had that, negative 0.4%, the treasury bond in a single week. It was moving very, very quickly, but it was also fairly consistent in how it was moving. Here in the last couple years, you got high spikes, you got low spikes, and they're coming every few weeks. And I think the takeaway here for industry professionals and, anyone that has an interest in where the housing market interest rates are going, it's the most volatile I feel like I've ever seen in my 19-year career. And that's significant because, like you said, Tyler, you may get something worked up on a Thursday, get it under contract on the weekend, and by Monday afternoon, when you've got your stuff in, everything's different. So, I mean, I feel like it's causing a lot more conversation. We need to have a better understanding of where things are going, where they could go, make sure that we're setting good expectations, but then following up and following through with that. That way we're not setting anyone up for failure when they actually, go to execute. Would that be your takeaway too?
Yeah, I think it's just, I noticed the same trend, like lots more highs and a lot more lows, and they all seem tied to key, whatever's the economic news of the week or the month. Does the Fed make a rate cut? Do they not? Is inflation report high or low? Is employment high or low? And those are causing those big spikes and those big drops. And so every week, that's what I love about the Monday Market Update. Every week we can come in here and see what's coming up this week. Is there a big potential major move coming this week due to some data? And it may just be because, just the age of social media and information that markets respond more with greater magnitude to key headlines. And then, you get all your algorithms and AI bots trying to buy or sell certain securities based on the headlines. And, it causes these big shifts like this.
Yeah, I think you're right. It's overreaction culture. And, you get so used to overreacting that just becomes reacting. And then from there, your definition of an overreaction becomes so severe. It's like what we've seen in the last week. It was already severe. It was already severely volatile. And now it's just kind of laughable, to lose 250 basis points in such a short amount of time, which brings us to our depressing slides. Let's go ahead and take a look. Been enjoying watching this for the last few weeks, but the last two, not so much. Just as a reminder for anyone tuning in for the first time here, the blue line is the most accurate. This is your overnight average interest rate from Mortgage News Daily. It's good. It's very accurate. The other two are trailing. The other two are the ones that you'll see in news reports, the MBS and the Freddie Mac, but it's not as good. So looking at this blue line, that's about as severe an uptick in rates. I guess we had something like this similar in October, but How has this impacted your business just in this last week, Tyler?
Yeah, I mean, for me, we saw a lot less locks across both my personal production, the branch, the company, and that could be that clients who went under contract are deciding to wait it out and hope that they get to see some recovery. That could be, real estate agents and loan officers educating their clients and talking about the rates jump, and the news talking about rates jump, so people kind of sit on the sidelines. And we could see this impact, homes that are on the market, or do they stay on the market longer because the buyer's not out there? Or does someone stop listing their house or delay listing their house because they want to see how this all shakes out? I actually have a friend from my neighborhood who they're interested in buying this new house, but they are concerned about listing their current house in this market. Obviously, depending on the company you work for and the industry you're in, you may be watching how the tariffs impact your own personal financial situation, not just the macroeconomic situation, more closely than others. So, a lot going on. And last week, we definitely saw a decrease in lock volume, and that may be because a lot of people locked up the week before when we had lower rates, or it could be that just the concern of the higher rates and wanting to wait it out and see what happens this week.
Yeah, I would agree with you on that. And, the unfortunate thing is when you've set an expectation, that becomes the expectation. That's the goal. And even, deviating slightly from that, it feels like a loss. And, unfortunately, we need to work on shifting that rhythm a little bit and making sure, part of my call to action today, it's a two-part. Part two, because I'll sweep it back around to the most important one, is we need to make sure as real estate professionals or anyone that is adjacent to the real estate world that we're having these conversations about our expectation setting, that it may not make sense or be in the best interest of anyone to really drill in and dial into exactly, when you're not in a position to lock an interest rate, when you don't have a specific property in mind that you can go under contract for, and rates have, maybe been dropping or getting a little more aggressive, you need to be, making that conversation very, very clear. Like, hey, yeah, this is where our payment range should be looking like, but, that's based on this. And here's where we've been. If someone's expecting a $2,700 payment and they come to lock and now it's $2,850, that could be the difference in moving forward on that contract or not. But if their expectations are, somewhere between $2,750 and $2,850, based on the movement that we've seen in the last week or two, you're going to have, people that can weather that. Because here's what happens if you don't set that up right. Now you've got someone last week, Monday or Tuesday, that said, okay, well, I'll wait for this to go back down. Surely this is a seesaw and we'll get some correction. Did we get correction last week? No, it got worse every single day last week. I mean, over and over and over, just kept taking it on the chin. So now that payment that was up just a little bit is now up a lot. And we as professionals need to know that there is that, that likelihood of it happening, and make sure to advise people the best that we can. Now, getting back to my call to action, number one, the thing that was on the forefront of my mind, getting into, what we talked about last week, we had so many people that wanted to lock in refis Thursday or Friday the week prior. And then by Monday, we saw the markets open poorly and we all pumped the brakes. But I think what this showed me is we need to be proactive and not reactive. We need to have a plan and a strategy in place. We need to know the trigger price and the trigger rate where it makes sense to help someone into a refinance. Have those discussions now while rates have gone up a little bit. So that way, when you do get that stuff that you're looking for, it's not a matter of making a bunch of phone calls, starting to work up some numbers, trying to get people sold on the idea. Now, have a plan in place now to where when that happens, you can move much quicker, because there are a lot of people that could have taken advantage, not this last Friday, but the Friday before, and who were unable to, because frankly, most loan originators weren't prepared to make that move that fast and protect everything that we saw that unfortunately was taken away before we had a chance Monday morning.
Yeah, to just kind of add to that, I had a lot of those conversations back in August and September. And, a lot of times it's, even if we bring the opportunity of refinance up to a client, they don't understand necessarily sometimes that level of urgency, because they think that, oh, it's Friday, let me talk it over on the weekend, I'll get back to you the beginning of next week. Like, it can be gone within a day, especially in these volatile times. So if we have these conversations now and tee them up front, then we can let them know as soon as it is time to take action that they're prepared and willing and ready to take action. So not just presenting them the information on the day that it makes sense, but presenting them the information well before it makes sense so they're ready to take action when the opportunity actually exists.
I love it. Getting that commitment up front, making sure we have a plan and ready to execute. Tyler, I appreciate you being on. Obviously, a bunch of fantastic insight. You're an expert in this field and, obviously know what you're talking about. So hopefully everyone benefit from your knowledge and experience here. We're going to be back next week. There's a lot of stuff going on this week that isn't necessarily going to be related to the economic data. So, we may put out some more information if you're not subscribed to the newsletters that we do or anything that your loan officers here at UMortgage are putting together. Hit us up, hit me up, make some comments in the chat. We'll keep you in the know. Now is the time to be the most educated, the most prepared as a real estate professional. And we're here to help get you there. Tyler, again, thank you for your time. We'll see everyone back here next Monday.
Thanks, Nash. Thanks, everyone.